Welcome to The Explainer. Today, we're going to decode the rule book that literally determines who pays for what in the buildings we use every single day. We're talking about the commercial real estate lease.
Okay, so here's our game plan. First, we're going to tackle the big core question at the heart of any lease. Then we'll climb what I like to call the ladder of responsibility. You'll see how risk shifts from the landlord all the way over to the tenant. We'll decode some of the key jargon, and then we'll tie it all together to show you why this stuff is absolutely mission critical if you're ever thinking about investing in property.
All right, Section 1, the core question. Before we get bogged down in any of the legal terms, let's just frame this with a really simple, everyday thought experiment.
So, yeah, when you're walking through an office building or a shopping center, who's footing the bill for the lights? The janitor? The property taxes? Is it the building owner? Or is it the business that's renting the space? Well, the answer to every single one of those questions is always found in one place: the lease. That's the document, the legal agreement that spells out exactly who pays for what.
Okay, on to Section 2, what I call the all-inclusive deal. This is the very first rung on our ladder of responsibility. It's the simplest structure you'll find, and it's where the landlord, well, they handle pretty much everything.
Think of a gross lease as the all-inclusive resort of the real estate world. You know, you pay one price and everything's included. For the tenant, it's fantastic. Super simple. You pay one flat rent and you're done. But here's the catch. All the risk, that lands squarely on the landlord. If property taxes suddenly shoot up or the HVAC system breaks down, that's their problem to solve, not yours.
And just look at this list. The landlord is on the hook for all of it. Taxes, insurance, common area maintenance, repairs, you name it. And that is exactly why the base rent in a gross lease is almost always higher. The landlord has to build in a buffer, right? A financial cushion to protect themselves from all these costs that could pop up at any time.
Now, to find a bit of a middle ground, you'll see this variation a lot, especially in office buildings. It's called a modified gross lease. It's kind of like a compromise. The landlord still covers most of the big stuff, but they might ask the tenant to pay for a few specific things, like their own utilities. It just gives the landlord a little more protection while keeping things pretty straightforward for the tenant.
Okay, time to start climbing that ladder of responsibility. We're moving into the world of net leases. And with these, you're going to see the burden of all those operating expenses start to shift, moving away from the landlord and onto the tenant's plate.
So here's how that shift actually works. It's pretty logical, actually. Each N, or net in the name, stands for a major expense category that gets passed on to the tenant. So with a single net, the tenant pays property taxes. With a double net, they pay taxes and insurance. And then you get to the big one, the industry standard for most retail and industrial properties, the triple net, or NNN lease, where they pay for everything.
So what does this really mean for the tenant? Well, fundamentally, it means they're the ones taking on the risk of all those unpredictable costs. Now, in exchange for taking on that risk, they usually get a lower base rent. But they lose that budget certainty they had with a gross lease. You know, if a massive snowstorm hits and the snow removal bill is insane, that's on them now.
And this chart just makes it crystal clear, doesn't it? Look at the columns. Gross lease, it's landlord, 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 all the way down. Then you look at the triple net lease, and it's tenant, tenant, tenant. It really all just boils down to one simple question. Who is carrying the financial risk?
All right, we've made it. We've reached the very top of the ladder. This is the peak of tenant responsibility, where the tenant is on the hook for, well, literally everything.
This right here is the absolute holy grail for a hands-off passive investor. You see these with big, single-tenant properties like a freestanding Walgreens or McDonald's. The tenant signs a super long-term lease, and for all intents and purposes, they treat that building like they own it. We're talking everything, right down to major structural repairs like replacing the entire roof.
Okay, so we've got the main structures down. Now for part 5, let's decode some of that fine print. Because believe me, with any commercial lease, the devil is always in the details. So first up is a big one, CAM, which stands for Common Area Maintenance. This is probably the most debated, most negotiated part of any lease. And why is that? Well, because it's kind of a catch-all bucket for every shared expense you can think of: landscaping, snow removal, parking lot maintenance, even security. And since those costs can swing wildly from year to year, it's a huge point of focus during negotiations.
So you might be wondering, how do you split up those CAM costs fairly when you've got a bunch of different tenants in one building? Well, that's where this term pro rata share comes into play. It's just a fancy way of saying you pay your fair share. It's what ensures that, say, the little coffee kiosk on the first floor isn't paying the same amount for parking lot repairs as the giant law firm that takes up 3 entire floors. It's all about paying for your proportional slice of the pie.
And here's another important one you'll see in those modified gross leases, the expense stop. This is basically the landlord's main line of defense against inflation. They'll agree to pay for operating expenses up to a certain amount, the stop, but anything above that limit, the tenant has to chip in for their share. It just sets a baseline and shifts the risk of future cost hikes over to the tenants.
So, after all that detail, we get to the bottom line. Why does any of this matter? Well, it matters because the lease structure isn't just some boring legal agreement. It is the thing that directly shapes a property's financial value and its entire risk profile.
Yeah, and it's really important to get this. Different property types have their own standard lease structures. It's just what investors and banks expect to see. So for a retail strip mall or a big industrial warehouse, you're almost guaranteed to find a triple net lease. But you walk into a multi-tenant office building, the standard there is much more likely to be a modified gross lease.
And just think about it from an investor's point of view for a second. Owning a property with a gross lease makes you an active manager. You're constantly watching every single cost. But owning a building with an absolute net lease, that's almost like owning a bond. You just sit back and collect a check every month. They are two completely, vastly different types of investments, even if the buildings themselves look identical from the outside.
And here's where that risk hits the bottom line, how it translates directly into dollars and cents. See, investors absolutely love the predictable, stable income that comes from a triple net lease, so they're willing to pay more for those properties. And in the world of real estate, when you pay more for the same amount of income, that results in what's called a lower cap rate. Think of it as a lower return on your investment. On the flip side, that riskier gross lease property, it has to offer a higher return, a higher cap rate to get an investor interested.
So, at the end of the day, understanding these leases isn't just about figuring out who pays the electric bill. It's about understanding the very foundation, the engine of the property's value. The lease is what defines the risk, it defines the cash flow, and it defines the entire nature of the investment itself.
So now that you know the rules of the game, which side of that lease would you rather be on? Would you prefer the predictability of being a tenant with a simple gross lease, or the hands-off passive income that comes with being a landlord with an absolute net lease? Whether you're an aspiring investor, a business owner, or maybe just curious about the buildings you walk past every day, getting a handle on the lease is the first and honestly the most important step. Thanks for watching.